Hi, my name is Z. I am a professional options trader, returning 25 to 50% on my portfolio every year. I do a lot of premium selling, and today we're going to look at TastyTrade's video on defending a strangle. Let's begin. As a disclaimer, I am just one trader, and my feedback and opinions on this trade are just that of my own. I think the TastyTrade team provides a lot of great content and material for options traders. I do follow their content quite a bit, and a lot of their studies are very interesting. I will link to their channel and this video in the description. Let's begin.
What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we are going to cover a strangle. I'm gonna look at AMD. It's been a bread and butter trade. It's one that I can put on some naked premium on in this Johnny Trader portfolio. It is going to use a little bit extra buying power, but I'm very, very light on positions here, so I'm okay with that. Stock has been trading between 140 and 180-ish for the better part of 2024. You can see this is kind of our range here. You have had some big spikes to the upside. I think this is a perfect short premium position for this sort of account.
So before he gets too much into the specifics of what he actually did on the trade, in general, when I am selling premium, I want the implied volatility to be greater than historical volatility. And when a stock goes into consolidation, that means there's going to be a big move coming. And this is kind of very basic in kind of price action. When a stock is consolidating in a range like this, especially a stock that is that has a big beta like AMD, there's going to be a large move. So I would not look to do any kind of premium selling when a stock is in this kind of pattern. And also, let's take a look at the implied volatility of AMD at that particular point in price. So you can see that the implied volatility around this time is, historically pretty low in the last, 6 months. And when you're selling premium, you're making a bet that implied volatility is lower than historical volatility. And in general, that bet is much better if you actually have high implied volatility to begin with. And the stock actually has really low implied volatility. So I don't think this is a very good candidate for selling premium at this particular time. But let's see what he does.
So I'm going to look at somewhere around a 1 standard deviation strangle here. So on the downside, maybe the 135 strike. We're looking in the August expiration, 51 days to go till expiration.
So this is where I think he makes the biggest mistake in this particular trade, is choosing this particular expiration, August 16th. And the main reason is because there's earnings for AMD in July. So his expiration is all the way out here in like August something, and there's an earnings call at the end of July. And what happens is when you sell premium behind a significant earnings or economic announcement, the premium does not decay, does not come out like you think it will, because that particular announcement will hold a lot of premium and expectation in that particular expiration, and therefore everything that the days before, the premium will come off extremely slowly. And let me show you how this manifests. So we are at the day that he put this on, and the expected move for 51 days out is a little $23 and change, right? And now let's move to the earnings date, which is July 30th. And now there's only 17 days left until expiration, but there's still over a $16 expected move in 17 days out. So you just sat there and you just waited 34 days, over a month, over 66%, over 2/3 of the time of expiration, and the expected move only moved down by like 30%. And you can see that there's $12 packed in just in the next 3 days. So not as much premium you think is coming off every single day just because of earnings. So I think that's actually one of the biggest. You just subjected yourself to an entire month of price action only to get 30% of the juice coming out of your premium, and you're selling like 20 deltas, so you're only getting like, out of the $6 that came off, you probably only got like $1 or $2 to come off on your options. If nothing else, nothing happened, or just a couple of dollars come off. So I think you have to be really careful which expiration. Don't just automatically sell 45 days out. You have to look at what actually happens in the next 45 days out. Maybe there's an election. Maybe there's some other event that will keep implied volatility extremely high, and you're not getting the bang for your buck when you're selling premium.
Going to look at the upside, maybe a tiny bit of short delta because of the skew here at the 190 strike. It trades around $5 and change. It does use more buying power than I typically like to use.
So he just picked the 135 strike and the 90 strike. My kind of question is, other than the delta that for the position that he wants on, like, why did he pick those strikes? And let's take a look at the price action for this. Like, say you are right here and you're looking at this entire price action right here. I mean, I think that it's very obvious the risk to this stock is to the upside, because you don't have, after 155 at least you have some support at like 140, but this is kind of more or less the blue sky, not a blue sky setup because there's a high right here, but there's a lot of white space right here that the stock can go up. So when you're putting your strike at a particular place, you need to look at where the supply and demand of the stock actually is, as opposed to just looking at the delta. And if you look at this drawdown that AMD has been on right here, 190 is not even at the 61.8 like retracement, and that is just like a run-of-the-mill retracement in a down move, in a directional move. So I think it's extremely important to have price action work in your favor even in premium selling, or else you are just basically making a bet that the market makers do not estimate the volatility of the stock properly, and you are better at doing that than they are, which I would say, unless if you're an extremely complicated hedge fund, you are not doing that better than market makers. So you need to have both price action and volatility bias in your favor in order to execute a trade.
I like to use about $1,000 in total risk in this portfolio. But given that I have so few positions on, I think it's time to add some short premium and put a little bit extra risk on here. So I'm looking at roughly a 1 standard deviation strangle. You can see pop is about 75%. When we look at the curve, our at expiration risk profile here.
So we're gonna fast forward a little bit because he just goes
to get
and fills the position for the next minute.
What's up, everyone? We've got a trade adjustment to make here into what has been a little bit of a down move after a huge move higher in AMD. So AMD down $5 here on what is looking like a weak market. You can see the stock has had quite the rally since we put this trade on. We put this trade on the 26th. If we go and look back here, it was trading somewhere around 160-ish. So the stock has rallied very, very significantly. We can actually pull up, if you right click on the order chains here, you can pull up the market snapshots, which will tell us a bunch of information.
So he's managing this position at this day here. So let's take a look. So the stock has run up to about this particular point right here, and he's deciding to manage the position. I think one big problem is that he's managing his positions a little too late. So for example, on this day right here, where the stock starts making a high above this consolidation, I mean, you know that come consolidation comes the biggest moves. Once it starts making higher highs, you absolutely need to start adjusting your position, because your position is now becoming a negative delta position. And if you have, when a stock is breaking up to the outside, you need to be long that stock, and you need to make sure that the position you have is commensurate with your price action bias. So I would have started adjusting immediately at this particular point. Now let's talk about when he adjusts it and how much risk he's taking. So if you saw in his screenshot, he's down about $400 on the trade. So if you look at his right here, it's marked at almost $900, $800.83. So he's down about $300, almost $400 on the trade. So when you're doing a premium selling trade or any trade, you need to look at the max loss that you are willing to have on this trade. Now, he said in the beginning of this trade that the probability of profit for this trade for him is around 75%. Well, what is the theoretical max loss on this trade if you want to be a break-even trader? Well, that's $450 because you will make $150 once, twice, three times, and then the fourth time you will lose. Well, how much are you willing to lose in the fourth time? $450. So and this is just being a break-even trader, not even a profitable trader, right? If you want to be a profitable trader, your max loss has to be less than $450. It'd be like $400, or you have to have a greater than 75% rate of success on this particular trade. But say, because he has no directional bias, no volatility bias, I mean, he's probably just taking the market makers like 75 pop, at face value and not making any improvements on that. So, your max loss for this trade is $450. You're coming up on $450 probably the day before because he's doing it on a down day. On the up day, he was already out like $500, $600. He would have, like in my mind, he would have hit the max theoretical loss that I would have allowed for this particular trade on the prior day. Now, what does that mean? That means you have to adjust your positions way before you even come close to max theoretical loss. But it's really important to focus on understand what is your max theoretical loss even for a premium selling position. And this is how premium sellers lose money in the long run, is that they don't understand the mathematics behind your rate of winning and your win-loss reward and making that commensurate with how much money you want to make in the long run.
About the stock. So at the time of the trade, it was at 159.50. You can see my overall delta exposure was only 5 short deltas, 6 short deltas here. Had a very high theta, of course, because it's a big position. IV rank at that time was 30. It's now 80. So you've had a lot of things work in our favor in terms of volatility, time decay. We've gotten hit by some delta though. Into this down move though, and this pop in volatility, it's an interesting point in time to consider rolling this position and rolling up that put. If we go to the trade page to look at our position, you can see this put, which we originally sold, at about $2.10 here, all the way up here. When we look at the chart of the option, you can do that by right-clicking here, going to view chart. You can see most of the value, if not all of the value, has come out of this trade. The stock has come down. If we pull up the change field, which gives us an idea of how much the option prices have changed. Obviously, we're making a little bit back on this call, but you can see we've gotten a little bit of juice pumped into the downside. That's a function of this move as well as a change in volatility. So we're going to take this put and try to flatten out our delta a bit. So if we look at the position here, if you remember, we started with 5 short deltas. We've now got 35 short deltas. So let's try and bring this back down to something a little bit more manageable. We'll say, 15 or 20 deltas, which would be a roll of about 10 or 15 deltas. So to do that, we would take this put, which is at the 135 strike. We can roll it to the 150 strike. That'll pick up about a net of about 8 deltas. We want to get about 10 or maybe 15. So let's go to the 155 strike. This will net us out 12 deltas, collect another $2 and change in premium, which is a relatively high credit here. Let's try and route this at the mid price, 226.
Okay, so he goes and tries to fill this order. So now I want to talk about his rolling of this particular position, the put side up. So he's moving it from his short strike from 135 to 155. That's a 20-point move, which is a pretty big move in my opinion, for just $2. A little bit more than like 225, 226 or something like that. I think that's a lot of risk to take on for a position that is 35 days out and above. I think a better way to do this is to, one, adjust much earlier in the trade. So, like I said, I would have adjusted on this candle right here as soon as it started breaking highs. Maybe even like if I were to wait a little bit, maybe when it started breaking like 170, I would have started adjusting the trade. And what you can do is nowadays in these, in most stocks, in these most optional stocks, there's just weekly expirations, and you have a lot of front expirations that you can use to find credit on the other side of the trade. So I'm getting challenged on the call side, and I have about $6 of, if you look, he has about, he's actually got about $8 right here of credit that needs to go to zero. Well, what I can do is I can start selling in the closer durations to finance. So I can start selling in the closer durations, maybe like, say this is 710, right? So I have all these expirations. Maybe I will sell 9 days out, and I'll pick up $60, 60 cents on this side, or $1 on this side. And what I can do is I can use that to complement a roll for the call to go out. So say, for example, I want to take $5 of risk out of the call side, moving it from 190 to 195. In order to do that, I need to pay $1.40. Okay, so I gotta find $1.40 somewhere. I can go to a closer expiration, and I can, find. I think this is a little greedy because the 167.5. This is really close to at the money. This is less than one standard deviation away from money. But say you do that, right? And so what happens? Well, the stock can keep going up, which makes your adjustment really good because the $150 of the put that you just sold goes out of the money, and you just got rid of $5 of risk on the upside. That's great, right? Or the stock goes down, which means that sure, the $150 is getting worse, it's getting bigger, but the credit, you have $6 of credit on the 195 call that's going down. So you're still happy on that in that situation as well. So using, this is what I kind of term fracking, or like breaking the premium. So say you have $6 of premium on the call side. Well, what you can do is, why don't I just move $1 on the call side, take 6, buy a vertical to turn that 6 to 5, and then take that $1 and put it on the put side. You're only going to get challenged on the call side or the put side. So, that both sides can't expire in the money at the same time. Therefore, you can kind of break the premium or the risk that you have on the trade. The second thing is, why did he move it up to 155 right here? He didn't really look at a chart. 155 is actually not a bad place to move it up. I'd probably move it up to like 150, because 155 is like, under here. This is all consolidation right here, right? You want to stay below the consolidation. So another thing I say is you have to be aware of where the supply and demand is for a stock when you're selling premium. You can't just work off of deltas. You need some kind of price action to help you as well, or else you're just at the whim of the market maker at that point. You're just clicking buttons.
No fill there.
Okay, sorry, I'm gonna fast forward this, or else this video is gonna take
All right,
forever.
so we got that in for 220 here, just rolling up that put. So that'll give us pretty decent credit on that position here.
I rolled 20 seconds forward. You just
What's up, everyone? We've got some adjustments to make in AMD here. The stock is near the lows. It's having a nice little rally today, up $4 or $5 at one point this morning. You can see it's had a lot of chop back and forth in this 150 to 170-ish range. We're out a couple $100 here, but lots of premium left in this position. So we've got this at the money put. When you look at the delta, you got about a 47 delta there. On the call side, we are short the 190. That's got about 10 deltas. So we've got about 30 to 40 long deltas here, net on this position. When we're managing a position and we're rolling down or up the untested side, we want to reduce our overall delta exposure by somewhere around 25 to 50%.
So this is one thing that I really disagree with him on, is that he thinks delta is risk. And I don't think delta is risk. I think risk is the likelihood of the possibility of the stock at expiration, and what is the likelihood of you hitting max loss on that particular trade is. So for example, you can sell an at the money strangle, right? And you have 0 delta on that particular trade. You have 50 delta on the call side and 50 delta on the put side, but you're taking max, like this is max max risk on this position, because anywhere the stock could be anywhere, and you will have to buy, that strangle back. It could, the stock can go to infinity or zero, and you'll be on the hook for all of that. You have a lot of risk, and and you have a normal distribution on top of the middle. So in my mind, so say you have a max risk of $450. Well, what is the likelihood of you hitting max risk with the current position that you have right now? That is the actual risk on the trade, not the amount of delta that you're taking on the trade. If you want, by this logic, the lowest amount of risk you're taking ever in a trade is just selling at the money strangles at all time. It's not all about delta. It's about how far away your strikes are. What is the probability of them being breached, and by how much? And that is dictated by the expected move.
We are long right now, 30 to 40 deltas. We'd want to pick up 10 to 20 deltas on a roll down of this call. So when we go to buy back this option, you click the ask price here. Trades at about $1. It's a 10 delta, so we want to pick up somewhere between 10 and 20 deltas. We could go to the 175 strike. This would pick up 12 deltas. We can go to the 170 strike. That would pick up about 18 deltas, and cut our overall position down to about 20 long deltas. So I'm going to roll this down to the 170 strike here. It's going to trade somewhere around this 273 mid price. Here you can see the delta. I'm picking up 18 short deltas against the 48 delta long call. So we're cutting this down significantly, and it'll add some more premium for us over the next 25 days as well. So we'll try and route this at 277, the mid price. We'll see if we get filled here on this order. And there we go. We got filled. So now we've got the 155, 170 strangle in AMD. We've got a total net credit of $10.06. It's currently trading at $12.62. So we're out about $200 and change here, but we've got a lot of time and a pretty wide range to hit here, all else being equal. So our break-even points will be somewhere around 145 on the downside. On the upside, it'd be around 180 because of that $10 in premium we have. So we'll see if this works out over the next couple weeks.
So if you look at the expected move that he's looking at right now, it's $15.8. His break even is at 145. This is less than one expected move. There is more than a 30% chance of, like, 20, 25, 30% chance that he's gonna be outside his break even on the put side, and that's just on the put side. On the call side, the break even on the call side is a little bit better. It has to go to like 185, so he's probably okay on the call side because that's like 2 standard deviations out. But here's the problem is that when you go outside, you're taking a lot of tail risk on that naked put that is already in the money. And in my opinion, if I were in this position right now, I would have just closed it for a $200 some loss, because there's a lot of tail risk that you're incurring. And the biggest problem is that you can be down at like 130, like the 130 strike, 125 strike, a couple weeks into the trade later. And even if you don't know if the market's going to come around or not, that's just like playing hope, right? You don't know if the market is coming. The likelihood of you being extremely down on this position is extremely high, and the upside of this position is $150, 150 whole bucks. And in my opinion, the risk reward at this particular point is not worth it. I would be closing out this position right now.
We'll see if this works out over the next couple weeks. What's up, everyone? So we've got a closing order today in AMD, which is up $14 and change here after earnings. E-mini S&P 500 futures having a very strong day here, up 60 points. NASDAQ up 400 and change. The chip stocks have been moving. So after earnings here, we've had the perfect move, right? So we had an in-the-money put at 155, an out-of-the-money call at 170. We sat with a little bit of long delta here just to lean a little bit directional into kind of the bottom end of the range. So this position It's trading at 864. You can see we've collected $10.06 in premium throughout this whole duration with the roll up and the roll down. So it's time to go with this position. 16 days to go till expiration. We're going to take this position and close it out for hopefully a nice little profit here.
So here he fills the order.
So we put that in at the mid price, 850, closed it out, $156 profit on this strangle. This stock has been moving. It's been in the money on the put side, in the money on the call side, a little bit of both, a lot of pain along the way, but staying mechanical, reducing your delta exposure, collecting extrinsic value have all mitigated that loss for a nice little win here.
Comment below on what strategy you'd like me to cover next. If you want to catch these trades live, tune in to Johnny Trades every Wednesday at 9:40 a.m. on Tasty Live. Peace.
Okay, so let's actually take a look. So he managed to close the trade for his $150, probably the hardest $150 he made in his life. But let's talk about what happened. Like, imagine before earnings, the stock was trading at 135. His break even was at 145. He was down $1,000 on the trade going into earnings. The earnings had a $12.3 expected move, and it could have so it went up on earnings $12, but it could have easily gone down $12, or God forbid, even more than that. And he took a gamble on earnings. It paid off for him. But you absolutely cannot do this if you want to stay in the game. You absolutely cannot gamble on earnings like that if you want to stay in the game and not blow your account. Because say it went down just one standard deviation, which is a very normal, expected. It's called the expected move. It is an expected move for the earnings. You would have been out to 2,000 plus on this trade. That would have been like over a year's worth of premium selling to make back just that loss. I personally think you absolutely could not, on the day of earnings, the day before he made this video, you absolutely could not hold that position into earnings unless if you are in hedge fund with an algorithm that can dynamically hedge your in the money put on the way down, which I'm pretty sure you're not. So let's take a look at, I kind of summarized my points here. So let's talk about the entry. The things my kind of feedback for this trade: do not sell premium when you're in a consolidation, because there's going to be a big move coming up. You need to check the implied volatility chart and make sure that you have high IV rank. So on Thinkorswim, you can pull up your IV rank percentile. That is something that I generally look at, usually over 50-60% IV rank percentile to go into a trade. Your strike placement, you can't just look at deltas and just put, just sell randomly at different deltas. You need to know where the buyers are. You need to know where the sellers are, and you need to sell on the outside of that. And lastly, and this is the most important thing, you have to make sure the event risk is after expiration, not before, so that the juice is actually coming out of your position. On the trade management side, I always harp on, like every profitable trader talks about risk management. And just because you're selling premium doesn't mean you can just ignore risk management. You need to know what is the likelihood of you winning on this trade? What is the max risk you are going to take on this trade, and obey by that. If you hit max risk, you need to get out of the trade, full stop. Number two, the use of closer dated expirations is kind of like a more nuanced way to find credit in the trade, but use every expiration you can to try and adjust and get free credit, in the trade. Use technicals to make decisions. If you're breaking out to the upside, you need to make sure you're long delta. And lastly, you cannot gamble on earnings. You might win and you're happy. You won, you made $150. Great. You lost $2,000. That does not seem like good risk reward, in my opinion. So I hope you enjoyed this content. Once again, I really thank the TastyTrade team, and I'll link their video in the description. Comment down below what else you want me to review, and I hope you have a great day.